All right, class, let's get started. Today, we are tackling a subject that is absolutely essential, not just for your exams, but for anyone who ever plans to invest their money. We're talking about calculating capital gains. You know, if you sell stocks, crypto, or really any kind of property for a profit, you have to know how this works. Okay, and just a quick note before we dive in, this material has been prepared specifically for our course. It's just a little academic credit where it's due. So let's set the scene. Imagine you've made a brilliant investment. You sell an asset for way more than you paid for it. It's a great feeling, right? But hold on. Before you start planning how to spend that money, there's one massive question you have to answer. After the tax man takes his cut, how much of that profit is actually yours to keep? That's the puzzle we're going to solve today. So here's our game plan. We'll kick things off with the core calculation itself. Then we'll get into the specific language of tax. It's super important. After that, we'll look at a really surprising concept called deemed disposition. Then we'll switch gears to strategy and talk about deferrals, and we'll wrap it all up with the key takeaways you absolutely need to know. Okay, first things first, the core calculation. You know, when you peel back all the layers, figuring out your capital gain is actually pretty straightforward. It all boils down to one simple formula. It really just comes down to 3 steps. Step 1, you take your proceeds of disposition, which is just the fancy government term for what you got for the asset. Step 2, from that, you subtract your adjusted cost base, or ACB, which is basically what it costs you. And step 3, you also subtract any direct expenses from the sale. And voila! What's left over? That's your capital gain. And if that number is negative, well, that's a capital loss. See? Not so bad. Now, here it is. This is probably the single most important rule when it comes to capital gains tax in Canada. You only pay tax on half of your gain. Yep, that's it. Only 50% of your capital gain actually gets added to your income for tax purposes. This is what we call the taxable capital gain. And believe me, this one little rule changes everything. Okay, so to really nail that formula, we need to speak the language of tax. And I can't stress this enough. The government uses very, very specific terms. They often mean something much broader than the words we use every day. So getting these definitions right is absolutely crucial. For example, you and I might just say selling price, but the correct tax term is proceeds of disposition. And there's a good reason it's a broader term. Same thing on the other side. We'd say purchase price, but the tax world says adjusted cost base, or ACB for short, because it covers more than just the price you paid. So what in the world are proceeds of disposition? Well, think of it as the total value you get. Sure, that can be cash from a sale, but what if your asset was destroyed and you got an insurance payout? That counts. What if you traded your asset for something else, like a different property? The fair market value of what you received in that trade, that counts too. It's a wide net, and that's on purpose. And what about your adjusted cost base, the ACB? Well, that's not just the sticker price. It's the grand total of everything it cost you to get that asset ready to go. You start with the purchase price, of course, but then you get to add things like brokerage fees for stocks or legal fees for a house, even installation costs. And this is actually great news for you because the higher your ACB, the lower your capital gain will be. Okay, so you've got the basics down for when you sell something, but now here comes the plot twist. What if I told you the government can say you disposed of a property triggering a tax bill, even if you never actually sold it? This is where we get into this wild concept called a deemed disposition. And trust me, this one catches a lot of people by surprise. The law literally deems, or, pretends, that a sale happened at fair market value. And that pretend sale can trigger a very real capital gain or loss. So when does this happen? Well, there are 4 big scenarios to watch out for. Number 1, if you gift a property to someone. 2, if you change how you use a property, say you turn your personal use cottage into a rental. 3, if you give up your Canadian residency and move abroad. And the big one, 4, upon a person's death, the law deems that all of their assets were sold right at that moment. Now, let's shift from just calculating the tax to actually planning for it. Let's talk strategy. So what if you sell an asset, but you don't get all the money right away? Well, the good news is you don't have to pay all the tax right away either. This is done by claiming what's called a capital gains reserve. Of course, there are rules. First off, claiming this reserve is your choice. It's optional. Second, you can't push the tax off forever. The maximum deferral is 5 years. And third, and this is the tricky one, You have to recognize a cumulative minimal of 20% of the gain each year. So after year 1, you need to have reported at least 20%. By year 2, at least 40%, year 3, 60%, and so on. Okay, let's make this real with an example. The total capital gain on this sale is $50,000. In the first year, the seller gets a payment of $80,000. Since the total sale price was $200,000, that payment is 40% of the total cash. So they have to recognize 40% of the gain. 40% of $50,000 is $20,000. Simple, right? Now we move into year 2. Another payment comes in, this time for $30,000. We just apply the exact same logic. We figure out what percentage of the total gain that payment represents. The math shows us we need to report an extra $7,500 of capital gain on this year's tax return, and the rest can still be deferred. Okay, now year 3. This is where that tricky rule comes into play. No payment was received. So you might think, great, no gain to report. But not so fast. Remember that cumulative 20% rule? By the end of year 3, we have to have reported at least 60% of the total gain. That rule forces us to recognize an additional $2,500, even though zero cash came in the door that year. And finally, year 4, the last payment comes in. Once all the money's been collected, that's it. You have to recognize whatever is left of the gain. No more deferrals are possible. In this case, that's the remaining $20,000. And just like that, over 4 years, the entire $50,000 gain has been reported. Whew, okay, that was a lot to take in, especially with that example. So let's step back and boil this all down to the absolute essentials. These are the cornerstones, the things you have to walk away with today. So let's recap the big 4. Number 1, the formula. Your gain is your proceeds minus your ACB plus your expenses. 2, the golden rule. Only half, 50% of that gain is actually taxable. 3, remember that disposition is a huge umbrella term. It's not just sales, it's gifts, changes in use, and even death. And 4, if you get paid over time, you can defer reporting that gain for up to 5 years. If you remember those 4 things, you're in great shape. See, here's the bottom line. Understanding these rules is what separates a passive investor from a smart, strategic one. It's never just about how much you make. It is always about how much you get to keep. So that leaves us with a final question for you to ponder. Now that you know the rules of the game, how will you manage your investments differently?